Hi, good afternoon, everyone. So before we look into our new topics today, so let us discuss the homework that I asked you to do last week. So hopefully you really did attempt this question. Actually, there is some missing information that I didn't realize last week, but nobody actually come back to me and ask about the missing information. But I still want to think positive that you really did attempt this question. So even though we are doing online learning and we can't really go through live session because my internet connection is quite poor here, so I'm trying to record a video so that you can still look at our new chapters. Okay, so but this requires your independent learning, so I hope that you really did attempt the question. All right, so before we look into the solution of this question, so let us recap what we have learned last week. So basically last week we have looked into deferred tax IAS 12. So what is deferred tax? It actually arises due to the difference between the accounting profit and taxable profit. So in this IAS, we only consider temporary differences that most likely arise due to the difference between the carrying value of the asset or liability and its tax base. So basically last week we have looked into the 5 steps of how we want to calculate deferred tax. So the first step is you must know how much is the carrying value of the asset. Secondly, you must calculate the tax written down value of the asset. Third step is you have to compare the carrying value and the tax base of the asset. So if the carrying value is higher than the tax base, so this will give deferred tax liability and otherwise. Step number 4 is for you to find the difference. How much is the difference? So CB minus TB, you get the difference and you have to multiply the difference with the tax rate. And lastly, you have to post the movement. So if the question indicate an increase in deferred tax liability, then you have to debit deferred tax expense, credit deferred tax liability. So let's look into the questions. So basically there are 3 scenarios here. Okay, so for all these 3 questions, you have to discuss the implication for the year ended 31st December 2009. Current tax rate is 30%. So this is the missing information that I did not provide you last week. Okay, so hopefully if you really did attempt this question, hopefully the tax rate is correct. If not, you just have to do another correction. You have to use a 30% tax rate. Okay, so let's look at the first one here. Alright, the first one is about property with a carrying value of 10 million and plant and equipment with a carrying value of 5 million. So we are talking about 2 different assets here, which is the property and also the plant and equipment. So you are given directly the carrying value for the financial year 31st December 2009. So meaning that you do not have to calculate the net book value by yourself. It is given to you. Alright. So value of the assets is tax value is 7 million and 4 million respectively. So this question is quite direct. Actually, it gives you the carrying value and tax base value directly. So what you have to do is you just need to compare the carrying value and the tax base and to find the temporary difference. So from this question, we know that the temporary difference from the property is 3 million. Carrying value minus tax base value, you get 3 million for property. For plant and equipment, another 1 million. So the total difference is 4 million. Alright, so next is you have to compare your carrying value and also your tax base value. So in this case, your carrying value is higher than the tax base. So this will give rise to deferred tax liability. Okay, so next is you must know how much that I should post under this deferred tax liability account. So you have to times with the tax rate 30%, and the amount to be recognized is 1.2 million pounds. So this is the double entry that you have to make. Debit the deferred tax expense by 1.2 million and credit the deferred tax liability. So always remember, since this one indicate an increase in liability, it will also increase your expenses. So this is the first question, which is quite straightforward. What you have to do is basically compare the carrying value and the tax base, because the carrying value and tax base is given directly to you. No calculation needed. Alright, so this is the first one. What about the second one? Okay, if you look into the second one here, so this time is about plant and equipment that you just bought on the 1st January, and the cost is for 1 million, and depreciation is 25% on a straight line basis. So this is your accounting depreciation. Okay, this 25% is for accounting purpose. Meanwhile, the local tax legislation permits the management to depreciate the asset at 30% a year for tax purpose. So this is the capital allowance for tax purpose. So the only difference between the previous question and this one is, this one you have to calculate the carrying value based on the percentage given to you. So that is the only difference. It's still about the same thing. It's about your asset, plant and equipment. So how do we do the calculation? So you can use a table like this, okay, whereby you can compare the carrying value as well as the tax base value of the asset. So let's look at this one first. Look at the carrying value. So when you look at the carrying value here, cost is 1 million given to you directly here, 1 million, and times with a depreciation rate of 25%. So this gives you carrying value of 750,000. So this is the carrying value for accounting purpose. But for tax base, you are allowed to depreciate the asset by 30%. So capital allowance 30%. This gives tax base value of the asset for 700,000. So this is the tax base value. Okay, so this is step number 1. Step number 2. Step number 3 is for you to compare the carrying value and tax base. So if you can see here, 750,000 is bigger than 700,000. So of course, this gives rise to deferred tax liability. And the difference is by 50,000. Okay, so how much that you should post? What is the amount that we should record? So you have to times with the tax rate. So this is your step number 4. And the last step is for you to do the posting. So, based on step number 4 here, deferred tax liability to be recognized is 15,000. So you debit your deferred tax expense by 15,000 and credit your deferred tax liability by the same amount. Okay, so if you compare this question and the previous question, actually no much different. It's the same steps that we go through. It's just that for this one, you are only given the depreciation rate and also the capital allowance rate, and you have to calculate the carrying value and the tax base value. That is the only difference. Okay, so I don't think this question is tricky for you if you really understand how to calculate deferred tax. So let's look at the last part. Alright, for the last part here, we acquired an asset for 250,000 on the 1st January 2008. Okay, do not get confused. Now, we are preparing financial statement for 31st December 2009. Okay, we are preparing for 2009. Alright, so meaning that this is the first year and you have to find how much is the deferred tax liability or asset that you have to recognize for the second year. Okay, so before we look at the treatment for the first year and second year, the step is still the same. The first step is for you to find what is the carrying value of the asset for 31st December 2009. So this one is the carrying value of the asset for the year 2009. Alright, so the cost of the asset is 250,000. So useful life is 10 years. So meaning that if you want to calculate the depreciation amount, okay, we go back here. Alright, so if you want to calculate the depreciation amount, you have to times with 2. Yes, why? Because now we are already in year 2. This asset, you have acquired this asset for the past 2 years. So accumulated depreciation is actually for 2 years. It is no longer for 1 year. It is for 2 years. So how do you calculate the accumulated depreciation? Very easy. 250,000 divide by 10 years and times 2, you get the accumulated depreciation of 50,000. So this gives you carrying value of 200,000. So this is the carrying value for 31st December 2009. Okay, this is the carrying value. Let's look into the tax base. So this is step number 2 for you to find what is the tax base value of the asset. So the cost is still the same. The initial cost is 250,000, but now the only difference is that this is your second year. Okay, last year you have already depreciate 100% for this capital allowance. So last year you have already claimed the maximum 250,000. So for this year it's nil. Nil meaning that 0. Why? Because your cost minus capital allowance is already 0. Why? Because last year you have claimed 100% capital allowance. So this year there's no more left for you. Alright? So this gives you tax base of nil or 0. Okay, the third step is you have to decide, is this a deferred tax liability or deferred tax asset? So you have to compare your carrying value and tax base. So obviously your carrying value is 200,000, way bigger than the tax base. So again, this gives rise to deferred tax liability. So for 31st December 2009, you have to recognize deferred tax liability of 60,000. You take the difference here, 200,000 times the tax rate. So deferred tax liability to be recognized for 31st December 2009 is 60,000. And remember, this is for the second year. You already have the opening balance for your deferred tax liability. So this one is a little bit different from the first and the second question, because in the first and second question, we are only looking for the treatment for the first year of acquisition. But this one, this asset is already in the second year. So last year, in year 1, when you have during the year of acquisition, carrying value is 225,000. How do you get 225 here? 250,000 minus with the depreciation, 25,000. You get for the first year 225,000. So let me write down here. I'm very sorry, I do not have a proper tool to do this. I'm just using my cursor. But hopefully you understand lah whatever that I'm trying to write here. 250,000 minus the depreciation 25,000. So this is for year 1. Okay, so that is why that's how I get 225,000 here. So since last year we have already claimed 100% of the capital allowance. So since last year our tax base is already 0. So 225,000 minus 0 give you difference of 225,000. times 30%. So last year, you have recognized deferred tax liability of 6,7,500. So how do I get 6,7,500 here? You take 225, the difference, times with the rate 30%. You get 6,7,500. So you debit your deferred tax expense and credit your deferred tax liability. So this is for the first year. But now, for the second year, based on this calculation, you know that the deferred tax that should be recognized is 60,000, meaning that you see a reduction in deferred tax liability. Last year, it was 67,000. This year, we have to record 60,000. So it's like this. So let's say this is your deferred tax liability account. So I just write DTL, deferred tax liability. So at the beginning of 2009, you have balance. Please apologize my improper writing here. So you have balance brought down of 6,7,500. And now, as at the end of 2009, your balance CD should be 60,000. 60,000. So meaning that there is a reduction by 7,500. So you have to do the reversal. So this one for the second year, for year 2009, we have to make sure that the balance CD is 60,000. So you have to do the adjustment by debiting the deferred tax liability 7,500, and this will decrease your deferred tax expense by 7,500 as well. So in the second year here, this is what we have to do. There is a reduction or there is a decrease in deferred tax liability. So you have to reverse the deferred tax liability that we have recognized from last year. Okay, so this is how you actually account for deferred tax liability. So in the next video, we will look into our new topic. So for this week, we will be covering 3 IFRS. Next video, we'll be talking about IAS 20, government grant. So I'll see you again in the next video.